Welcome to the Money Maze podcast. I'm Simon Brewer, and along with my co-founder, Will Campion, we created this show in 2020 to explore and unravel some of the mysteries surrounding the investment and business worlds. Episodes are available on audio via most podcast platforms and on video via our YouTube channel, and we're active on all major social media platforms. To stay up to date with every episode, please do sign up to our newsletter at moneymazepodcast.com. And we'd like to thank you for listening. And if we could ask one favor, we'd love you to tell a friend or colleague about us. Thank you. Bill Gates said software is the magic whose importance only goes up over time. And 90% of software companies in the world are private still today. And what is even more extraordinary is Vista Equity Partners is the fourth largest software firm in the world. Rachel, we're going to turn to you because having dealt with the top-down view of this software, you run or co-run the Endeavour fund, which is a smaller cap strategy within Vista. You run a business, you've been a CEO, you know the tech space, and you're running this firm, which makes it unusual because lots of people in the investment business, have not been practitioners. So apart from the fact it's great to have you here, and you've been doing this for a long time, I'd like to start by you setting the scene for what's going on in the world of software.
Yeah, thanks so much, and I appreciate you having me here today. It's been a wonderful SuperReturn kickoff, and I hope everyone has enjoyed the event. From a software perspective, we're really sitting in an interesting point in time. To your point, a question that I get often is, has the opportunity to invest in enterprise software passed? And I think what's interesting about that is it really doesn't recognize the fact that every business at scale, but also small businesses in every sector around the world, really is using software to optimize their operations. That includes things like how to market to new customers and grow revenue, but also save money and become more efficient. And so what's compelling about that to us is that we're still very much on the early side of global adoption. And so the investing market still represents a really material opportunity from our perspective to both get in and support companies that are disintermediating larger behemoths in the technology space, but then also still really power the digitization of, again, sectors around the world. We actually have a business in our portfolio called Innovative that services heavy manufacturing in asset-intensive industries. And again, you would assume most companies are automated at this point. But these industries are still actually using triplicates and clipboards, and I know some of us remember triplicates and typewriters. And we think that the opportunity here is still for these organizations to automate and activate workflow in a way that actually improves safety and overall kind of process management, but also just creates long-term, really powerful ROI for these organizations. So all that to say, we're early, even though we're many decades in to the enterprise software motion, and we couldn't be more excited about what's still to come.
And it's proven to be incredibly economically resilient, the whole software space. And for old timers like myself, you go, my gosh, I've been asleep at the wheel because, the change is, and when you said typewriters, you looked at me, so I'm a bit worried about that. But tell us a little bit about what are the priorities for the CEOs and CTOs at the companies you're dealing with? Where are you in that priority stack?
Yeah, absolutely. So the companies that the Endeavour Fund invests in tend to be 10 to 40 million of entry point annual recurring revenue. They have mission critical products that have established product market fit, so relatively low existential risk. And these are companies that are going through what we believe is one of the most powerful and valuable chapters of a software company's life cycle. They're building out their first executive team, maybe hiring their first CFO. They tend to be, for the first time, thinking about how do I automate processes because I now have thousands of customers instead of hundreds. And they start to really grow their employee base, which is, as we all know, kind of creates all sorts of opportunities and challenges. So when we think about the work we do with these CEOs and founders, we're arming them with the best practices that have been honed in the 24 years that we've been operating from a Vista standpoint. We also bring to them some incredible resources in the form of a value creation consulting team, an operating partner team that rolls up their sleeves to help these CEOs, almost like a coach. What I think is interesting is so many founders these days actually don't aspire to go public the same way that they did maybe 20 years ago, as we were all kind of, on the scene from a public market standpoint. And what's interesting is they now see an opportunity to build a durable, long-term value-creating business, but they don't see that same exit potential. And so what they're looking for instead are private investors who bring much more than capital, but actually truly value-add services to help them grow their business to be the best it can be.
So you are a private equity investor who's also providing effectively consultancy services.
Correct.
So are you parachuting people into those businesses continuously?
What we have is over 105 individuals that are captive, that work full-time for Vista, that are subject matter experts in everything from pricing and packaging, generative AI, cybersecurity, things like sales training. And so when our CEOs come out of a board meeting and they say, here are my priorities for the next quarter, we're then able to bring them some of these resources in a typical consultative fashion, where we're then helping their management teams bring some of these initiatives to life. And because at a Vista level, we've been doing this, we crossed over not only 100 billion in AUM last year, we also crossed over 610 software transactions, which from a deal team perspective, I think is more powerful because it speaks to the repeatability and the depth and exposure that we have in this market. And so those best practices have been well honed over multiple decades. But also, candidly, Simon, the magic happens when a very talented management team says, how do I apply this to my market, my business, and my team? Because there is no one size fits all, as we know. And I think at the end of the day, that's really what's driving results.
So help me. We got an audience here and outside who look at funds like yours, very successful long-term track records, but they're thinking about exits and they're thinking about IRRs. You go and you buy a company and it's a great company. Like Buffett, you might go, big moat, fantastic, runway. I never want to sell it. How do we marry those two things?
We do have a fiduciary responsibility to our LPs, which we take very seriously around the return of capital. So there is always at some point an exit. We, despite the market challenges over the past couple of years, we've continued to find ways to be creative about how we do that capital return. And when I think about the success we've had even recently, again, despite kind of, lower deal volumes, it's been because of that value creation. We've always built long-term, very valuable businesses. These are businesses that have healthy growth strategies, that are operating in a very efficient fashion, but also still have a lot to build on. And those are always in high demand. And so I think, when I think about the long-term opportunity for our investors, but also our management teams who we want to incent to be wildly successful, it really is about building a business that's going to be a market leader beyond all of our involvement.
So before we continue this conversation, we're going to take a short break to have a note from our sponsors. The Money Maze podcast is sponsored by IFM Investors, a global institutional asset manager whose purpose is to invest, protect, and grow the long-term retirement savings of working people. Owned by pension funds and inspired by their members, they invest in what matters. As a responsible investor, IFM actively engages with their portfolio companies on issues they care about, with the aim of improving net performance whilst minimizing risk. They manage investments across infrastructure, debt, listed equities, and private equity assets. To learn more, tap the link in the episode description below. So we listened to the CEO of Carlyle yesterday talk about taking his portfolio company CEOs, putting them in a room, talking about AI. Lots of chat about AI on the ground. How are you facilitating this new world?
Yeah. We believe AI is creating a really meaningful and powerful inflection point for enterprise software. And I think we're starting to see the effects of that already in accelerated innovation cycles, which is very exciting. Also, in that there is a potential here that generative AI actually remakes the already very valuable business model for software companies. And what I mean by that is that the efficiencies that our teams are already seeing, simple things like a marketing team using generative AI to create copy, then to more powerful things such as a development team actually getting more efficient in their code generation. All of those items are actually going to give us an opportunity to have even more cost efficiency, but also better output. And so what we're seeing here from an opportunity standpoint is pretty tremendous, but it's early. And so the work that we're doing in our portfolio today is really threefold. I think first, and I would say really from an exciting standpoint, all of our 85 companies have committed to having an AI-based product in market by the end of the year. So having more powerful offerings that they can take to their end customers to drive up that ROI is a home run. The second is the code generation. When you think about a software company, the most expensive portion of the profile is actually the R&D line. That's actually where you're driving future innovation, you're driving that competitive moat. And what we're excited about are that some of the tools that have come out from a code generation and development standpoint are world-class. They're phenomenal tools. I was actually with one of our portfolio CEOs a few weeks ago, and he mentioned to me that his team had created 2 million lines of code in 1 quarter. That's an incredible feat and something that 5 years ago I wouldn't have even believed. And so, the ability for the innovation cycles to pick up, for us to have better products out in market faster, will change the landscape. So that's an important part that all of our companies are working on today. And then the final area are the internal operations. How do we think about areas where you can create automation inside of the business so that you can get more efficient, again, with all of your operating expenses? And so we're seeing incredible progress on that front as well. And so from an operator standpoint, those are our 3 priorities. As an investor, we're very thoughtful about both the risks and the opportunities that exist with generative AI and what that means for potential investments. So we're actually spending a significant amount of time with potential investments on things like their technology roadmap, their tech stack, data mapping, as well as their teams and their readiness. Because we see, in this dynamic of an environment, both, again, bigger opportunities, but also some material risks still on the horizon.
And when we think, I can go all the way back to when PE really started going, it was about cost reduction, and then we talk about revenue enhancement. When we talk about AI and its application, would you say that initially the focus is more on helping manage the cost base, or is it just as much about revenue growth?
I really think there's huge opportunity on both fronts. I, as a product geek at heart, I really do enjoy kind of the product side of the work we do. I think that innovation cycles here are going to really be game changing. And so, when we think about what it means to have market leading products with the best LLM-based integrations, again, I think the future is very bright. And so that will drive revenue, it will drive market position and market capture. And then obviously, to your point, it's not just about cost savings from our perspective. It's about how do you build a company that's well run and optimized that isn't going to be in a great position for the long haul. And so that capital efficiency, the thoughtfulness that we look for on that side is absolutely also going to benefit from these tools. I would say we should have high expectations on both fronts.
So before we continue this conversation, we're going to take a short break to have a note from our sponsors. In times of economic and geopolitical volatility, investors will look to gold. Today, as the world navigates uncertainty and heightened risk, investors of all sorts will look to safeguard their wealth. We're thrilled to welcome the World Gold Council as one of our sponsors. Tap the link in the show notes to learn more, or visit goldhub.org on your browser for comprehensive research, insights, and analysis on the global gold market. How do you think about constructing the portfolio? How many companies make for an optimal mix, and what sort of industry dispersion do you want? And I say that because whilst the hype is around NVIDIA, and again, old timers will look and shake their head at the valuation, isn't it the old industries that potentially have the most to gain from what's going on?
Absolutely. We really look for industries where our products and our companies can have staying power. I would say because we're focused at a Vista level on really high quality companies with mission critical products, we look at gross retention, and lost only retention is one of our most important metrics. And so in terms of areas of focus, we are looking at the industries where the opportunity to really change the landscape with technology, demonstrate high ROI is already in place. And then from a portfolio construction standpoint, Vista is primarily a buyout investor. We typically do only control investments. In the Endeavour fund, which is the fund that I co-head, because we're focused on a life stage of kind of 10 to 40 million of entry point ARR, we also do some structured minority work. So 80% of our fund two was control, and then 20% was structured minority. But the consistency across the profile of these businesses is tremendous. Again, these are companies with, really healthy growth, very high gross retention, very strong gross margins, recurring revenue. And so the opportunity for us to take these businesses and help build them into market leaders, that have over 50 to 100 million in revenue is something that we enjoy quite a bit.
Now, on my travels, and I sit on some investment committees, I see almost no dedicated allocations to this space, software generally, let alone sort of a niche area. Who are the types of investors best suited to what you do?
Yeah, what's interesting about what you're mentioning, Simon, is we don't view software as a subsector or a sector that you would think about as a dedicated allocation. Because when you think about how software is the cohesive and connective tissue of every business on the planet, you actually have an opportunity through software to get exposure to different sectors and then, to your point, different scale and sizes. And so, when we think about the opportunity set and the types of investors, I personally believe every investor should be a software investor. Again, it gives you access and exposure that's far superior to many other industries. But it also tends to be someone who's thinking about how they want a risk-adjusted opportunity set into one of the most powerful economic models that's in existence today.
Cohesive and connective tissue. I like that. I might steal that particular line and redeploy it. We're talking, you're American, I'm British, we're here in Berlin. Is all the world marching to the same drum, or have you got quite big geographic dispersions? Tell me about how you think about where the opportunities are, or there's simply so many on your doorstep you don't need to really do anything other than come to Berlin.
It's a great question. I think, as you mentioned earlier, there's over 100,000 software companies globally today. And for our fund, we're primarily focused in North America because we're tracking 60,000 companies, again, in that 10 to 40 million of revenue stage. And so the opportunity set is tremendous. I think what's exciting, though, is that we're starting to see a new phase of investing. But in terms of geographic distribution, again, with better development tools, you're seeing companies pop up all over the world that are truly disintermediating existing behemoths. And so when I think about the opportunity set by geography, I think better tools and more and stronger global access to computing power will be kind of the leveling of the playing field, if you will.
And is your client base as global as one might imagine?
Absolutely. Very globally dispersed. And again, I think because of, to your earlier point, the strength of our track record and the history we have of building really valuable companies, we continue to have very valuable, productive relationships.
And when you think, coming back to that portfolio construction, help me understand a little bit about how you segment either industries or you do the classic, what I would call risk management. So that maybe what I'm really asking is, how do you think about risk management along with diversification?
Absolutely. I think both of those are all of our jobs, right? From a portfolio management standpoint, we do have 12 sectors that we really focus on, not to say we wouldn't work outside those sectors in our fund. But what we found are that there are some industries that once technology kind of takes hold, it tends to retain. It tends to be very sticky. And what we want to see from an opportunity set perspective is that revenue be consistent and recurring, which is the most powerful part of the enterprise software business model. And so those sectors, everything from heavy manufacturing to things like GRC or legal tech, really create incredible opportunities and kind of markets for us to deploy technology into. And from a risk management standpoint, we run a highly diversified portfolio. To your point, right now we actually don't have any asset over 10% of the fund. We also run a very low leverage ratio. We're sitting with our over $2 billion of AUM with just under 11% of leverage. And so we're very thoughtful that at this life stage, things like interest rate expense can actually be challenging for a company. And so we're thoughtful about how do we ensure, again, a company isn't set up just for success during our hold period, but that it will be a prevailing leader in 10 to 20 years.
I want to come back to that earlier question, which is the life cycle of a fund, because I remember Robert Smith, I think, telling me that you also have a permanent, not you, but the firm has a permanent capital vehicle. Yeah. Just tell me how that works, because it seems that there's coming back to those great companies that you just don't want to let go.
Right. Yeah, absolutely. Right now, so the fund is called Perennial. It really kind of reflects, to your point, the opportunity to invest in established, enduring market leaders. And so, right now they have two really material investments that, again, are market-driving software providers. And it really does give us a chance to continue to build on an established, scaled asset. And so we're excited about the opportunity for our perennial fund.
Well, I don't know whether there are any questions from the audience. There's a gentleman there, hand up.
My name is Alfonso. I'm the founder of a software company. We've automated the reporting of portfolio companies to the fund and portfolio monitoring. My background is in private equity, CLOs, leverage finance, and we're addressing that problem. So the question is not in regards to investing in technology, but adopting the technology at the GP level, and how you see the opportunity of automating the CFO suite a little. You've mentioned about new CFOs, etc., which by extension means automating and digitalizing the reporting to you and your portfolio analytics.
Yeah, absolutely. So, I think what is exciting is that there's such an incredible opportunity for us to look at portfolio company data and take both the analytics and the insights to actually extract what's happening more broadly in end sectors, to your point, Simon, on what's happening kind of in the view we get into those end sectors through our portfolio companies, but then also to be able to aggregate to make portfolio management much easier for our clients and LPs. And so, we're actually currently in the process of digitizing a large part of that workflow for ourselves. We had started actually some of the data aggregation for all 85 companies, I want to say about 7 or 8 years ago. And as you can imagine, the data continues to grow. And so better, stronger tools that actually provide our LPs even better insights, I think is still an incredible opportunity. We're on that journey now, as I imagine many of our peers are. And so it's exciting to see what will come out of it.
Now, investing, as we know, is a game of successes and a game of having some failures. What have you learned from the endeavors that have not been as successful?
Yes, it's a great question. It really is about being self-aware as a product and around where we do our best work, targeting the right size and scale, and then being really selective about the opportunity set. And when you have when you're tracking 60,000 companies, you can actually be extremely selective, which is a great place to be.
So we had an interview a couple of weeks ago with the founder of Strava, who's also a PhD in economics, and he said, just remember that if the bottom-up story is strong enough, it swamps the economic cycle. Would you say that recession or no recession ahead, that you have a relatively high degree of confidence in the resilience of these businesses?
Absolutely. I think what's interesting, we went through the global pandemic a few years ago, which was so intense on so many levels. And when we've looked back, one of the things that was interesting is that we had a number of our companies, the majority of them actually, where their renewal rates stayed strong and in some cases increased. And what we took away from that was that some of these end customers actually weren't paying rent, but they were still paying their software renewals. And when you look and peel back kind of why that would be, it's because their core data to run their business is sitting in enterprise software. And so despite market environments, we really believe that, again, these mission-critical, very sticky software products will continue to succeed and grow, which gives us confidence for regardless of where the future may lie, that we have some incredible upside still to achieve.
Rachel Arnold, Vista Equity Partners, thank you very much.
Thank you, Simon.
Schroders is a $950 billion global investment house focused on asset and wealth management. The breadth of capabilities within their businesses gives Schroders scale and reach to understand and serve clients' complex needs through actively managed investment solutions across the complete spectrum of public and private markets. Remember, capital is at risk when investing.